Now, I'm pleased to present today's speaker, RPAG's investment associate and today's camp counselor, Karina Gascon. Karina?
Hi, everyone. I'm so excited to be kicking off this year's summer camp series. Today, I will be going over how to use the scorecard to win gold. So we'll be starting with an RPAG mini Olympic series, and I'll be walking you through the scorecard, talking about what the scorecard tells you, how to use it, and how RPAG scores funds, and then why we use it, all those advantages that the scorecard holds. So I'm excited to walk you through that as your camp counselor today. So to kick things off, let's start with what does the scorecard tell you? So the scorecard is designed and was designed to create a way to score funds in an easy to read and easy to manage way. So we have the result of that is a straightforward 10-point numerical scoring system, and it outlines a couple objectives that the scorecard has in place. So I'll start with objective 1 that the scorecard has, which is identifying skillful managers. So the scorecard allows us to look at strong performance of a manager over an entire market cycle. We're not looking at short-term performance or short-term metrics here. We're looking at the scorecard and these funds through an entire market cycle. So that allows us to identify skillful managers through the scorecard system. The second objective is that the scorecard enhances the investment due diligence process. So it allows us to analyze different asset classes and funds in a robust manner using different analytics that are more complex and more in depth than what we would normally look at with just straight returns and expenses. So it enhances that investment due diligence process by looking at a lot of different quantitative and qualitative factors and not just simple analytics. And then the final objective is that the scorecard minimizes exposure to fiduciary liability. So it creates a repeatable and documentable process for plan sponsors to use, which allows them to minimize that liability by having that documented and defined process set in place. So that's what the scorecard is designed to do. It has three main objectives, I'll say, and it's that straightforward, easy 10-point numerical system. So let's dive a little bit deeper into the capabilities of the scorecard. There's a lot of different capabilities that the scorecard has. I'm just going to touch on 4 main ones today. The first one, I touched on it on the first slide. It's a simple, easy to understand number that each fund is scored with. Scores are 0 to 10. That easy one scored number is a great way for fiduciaries and plan sponsors to manage their fund lineups. The second capability is that the scorecard can tell us how our fund is doing and allows us to manage our fund lineup in an easy way. So funds are scored in that 0 to 10 format, 10 being the best, 0 being the worst. And it tells us through those different scores whether we should add funds, eliminate funds, watch list funds, or maintain funds on our plan lineup. So with those eliminate funds, we're just looking at those as potential eliminations. It tells us to do some extra quantitative or qualitative due diligence, and same with watch list. They're just flags so that we can monitor them more closely than those funds that are earning acceptable scores. And so that leads me to the next capability of the scorecard, which is that it's integrated directly into the investment policy statement. So by using that methodology that I just outlined, that add, eliminate, and watch list methods, we can easily integrate it into the IPS. And then the final capability is that it's an easy identifier for those areas of concerns for specific funds. So the scorecard, I'll walk through it specifically to show you the different segments of it. But what it does is that it segments each different analytic so that we're able to see what areas the fund may have concern areas in. And so we're able to see such areas such as style, risk return, peer group, and qualitative factors, so we can dive deeper into those different areas of concern. So great capabilities that this scorecard has. Let's go into how does RPAG score funds? I didn't mention at the start, but there is a Q&A box, so I'll be looking at that throughout the presentation. If you guys have questions, feel free to send them through that portion, and I will be looking at them throughout the presentation. So now let's dive. We went over what the scorecard does and what the scorecard tells us, its capabilities. Let's dive deeper into how does RPAG actually score those funds. Here, I like to say this as that it's a great differentiator for RPAG is that our scoring system actually categorizes funds. So we don't group all funds together in our scoring process. We actually break them out into these three categories: active, asset allocation, and passive. So what this allows us to do is that we customize these analytics for each of these categories to fund specific goals. So active funds are much different from passive. They, are looking for that active management, beating the benchmark, whereas passive, we're just indexing to the benchmark and want to track that. So by breaking out the categories, we're able to customize each scoring system and create custom peer groups that allow us to have better analysis in our fund due diligence. All scores are built with pass-fail analytics. So they're scored on a scale of 0 to 10, with 10 being at the best. The scorecard is broken out 80% quantitative factors and 20% qualitative factors. So with those quantitative factors, they make up 8 unique factors, which I'll go into a little bit more closely in the next couple slides. Those incorporate such things as modern portfolio theory statistics, quadratic optimization analysis, and peer group rankings, which I touched on a little bit before, and I'll get into deeper as we move through the presentation. And then finally, the scorecard is 20% qualitative factors. So we look at manager tenure. For active funds specifically, we want to make sure that the team that was put in place has been there for a long time. And we like to look at that from a qualitative perspective. Fund expense ratios. We don't want a very expensive fund in our fund lineup. We want to make sure that we're getting the best expense ratio out there for our plan sponsors. And then we look at the fund's strength of statistics. So we want to make sure that some of those quantitative factors, specifically the style areas, which I'll get into in the next couple of slides, have statistical significance. So that's how RPAG breaks out the funds in the scoring process. And I'll dive deeper into that here by going over that first category, active funds. So with active funds, we utilize 5 years of monthly returns for our scoring system. Now, 5 years gives us a great sample size of 60 data points. So we're able to know that what we're looking at has statistical significance. So what do we look for in an ideal active manager? A lot of different things, but the scorecard specifically looks towards these 4 main goals. First one, style purity. We really want to make sure that our manager is staying pure to its stated objective and asset class. They're not steering into a different style analytic. So I'll give an example here. Let's choose large cap value, for instance. A large cap value manager, if we're buying into that fund or adding it to our investment lineup, we want to make sure that it stays pure to its large cap value style. It's not buying stocks down in the mid and small cap categorizations. It's not going more growth oriented. We want to make sure that it's staying true to its large cap and value orientation. So that's really important with active manager and something we look at in the scorecard itself. The second is outperformance. So we want to make sure we get what we're paying for with outperformance with an active manager. Now that can be on an absolute basis in that return side, so they're beating their benchmark and or peers. We can also look at it from a risk adjusted basis. So a fund can give us that downside protection in down markets and have better protection there. And then the third thing we look for in an ideal active manager are high peer group rankings. So we not only want to see that outperformance against the benchmark, but we also want to make sure that the fund is ranking well against peers and that we've chosen a good fund. I'll highlight here again, we use those custom RPAG peer groups. I'll go into that a little bit more. And then finally, our ideal active manager should provide a long track record. We want to make sure that team and process has stayed in place, that portfolio manager that was added at the time of the fund being added has stayed there for a long time. Another thing with active funds is that we use industry standard benchmarks for specific asset classes. So we use Russell, those Russell 1000 growth, Russell 1000 values, etc., MSCI, ACWI, Bloomberg Barclays, we use the intermediate ag. So we use industry standard benchmarks to compare on a scorecard. And then finally, RPAG utilizes custom peer groups that emit passive funds from the peer group rankings. So this allows us to have a way better apples to apples comparison than we would if we grouped them all together. I like to use a simple example just to highlight why it's important to group these different categories out, separate active and passive. The fixed income space in the last couple of years, active managers have been able to outperform the benchmark by a lot by taking on additional credit risk. So if we lumped active and passive funds together, we wouldn't be able to see how well active funds in that space have been able to beat their benchmark because we'd have those passive funds bogging the peer group down. So by separating the two, we're able to have that better, again, apples to apples comparison and have a more in-depth analysis. So that's super important. And I would say a huge differentiator with the RPAG scorecard. Now, diving deeper into the actual scorecard, the factors we use on there and the different analytics, this is a lot of information thrown at you at once. I'll start by breaking it down easily in that left-hand column there. As I mentioned previously, our scorecard across all categories is broken out 80% quantitative factors and 20% qualitative factors. So those 80% factors are those style factors. Again, touching on what I just spoke about with that style purity, we want to make sure using a returns-based style analysis that our fund is plotting in the correct category. If it's a large cap value manager, it's staying true to its color and not drifting down into mid or small cap capitalization area or drifting to the other side of the quadrant to the growth-oriented section. So we want to make sure that it's pure in style and continues to do what its stated objective is. The second area of those quantitative factors is risk-return factors. This is that outperformance I mentioned in the previous slide. If we're buying into an active fund, we want to see that they're adding value with the outperformance, whether that's on an absolute basis with returns or on a risk-adjusted basis in that downside area. So we're able to measure it there with those three analytics with risk-return factors. And then finally, in the quantitative space, we have those peer group rankings. Again, just to hit the nail on the head, we'd use custom peer groups here. So we compare apples to apples, active funds against active funds in this space. So returns and information ratio are what we use for peer group rankings here. And then finally, that qualitative factors, we look at manager tenure. Super important with an active manager. We want to see that that team has stayed in place for a long time, and points will be deducted if there's a manager that leaves, portfolio manager that is. And then we look at fund expenses. We want to make sure we're getting a good expense ratio for our plan sponsors and participants. And then finally, strength of statistics. We want to make sure specifically those style factors have strong statistical significance, so we know that what we're looking at is relevant. All right, so that's the active category. Now I'll move into the asset allocation separate. All right, so I just popped up the question and answers here. I'll pause here. I see a question about why do some funds that score higher than a 6 have a yellow or red flag next to them? That relates to our watch list. It takes up to 4 quarters for a fund to come off watch list. So if they score a 6 and the next quarter they score a 9, we're going to keep that fund on watch list for 4 quarters to make sure that they continue scoring an acceptable score. Same thing for the red flag, that means elimination. It's the same methodology there. If it jumps back up to a fund, to a score that is in that acceptable category, we'll still keep that flag there to maintain some extra due diligence around that. So that's an important aspect in doing both your quantitative and qualitative investment due diligence there. So with that question answer, I'll move into the next category, asset allocation funds. So with active allocation funds, these are super similar to active funds and how we score them in the analytics that we look at. So asset allocation funds, what type of funds are those? Here, we're looking at target date funds, risk-based funds, balanced fund, and multi-sector bonds. Again, I mentioned they're very similar to active funds. We're still looking at those 5 years of monthly data. So 5 years of history, giving us a great sample set to make sure that we have statistical significance in the data we're looking at. We still want to look for outperformance. It's very important with an asset allocation fund. Long track record, so make sure that team has not changed and is still in place and has been for a long time to know that what we're getting is what we started with. And then we look for high peer group rankings. So again, custom peer groups, we want to make sure that they not only outperform their custom style benchmark, which I'll explain a little bit in a second, but that they're also beating their peers and that they're ranking well against their peers. All right, so then if everything is so similar to active funds, what's different? Here we look at different style analytics. With asset allocation funds, we want to look for diversification among those underlying investments. So we add we swap out style analytics for different style analytics to better evaluate the diversification of the fund manager. Another unique portion here is that, and what's different from active funds, is that we use RPAG custom style benchmarks. So I alluded to it before. Here, we don't use industry standard benchmarks because there really isn't one for this space. There is no 2045 vintage in a target date fund is the same as another 2045 vintage. No balanced fund is the same as another. So here, RPAG is also unique in that we adopt quadratic regression to create custom style benchmarks using the 4 main asset classes, US equities, international equities, US fixed income, and cash, to create a custom unique style benchmark for each asset allocation fund. I'll highlight here, if you pull an asset class review, you're able to see that benchmark and dive a little bit deeper into the due diligence aspect on that asset class review for each asset allocation fund. So it's a great tool to see the custom style benchmark, what it looks like for each fund. So recommend that tool and fund lookup there. Now, let's move on to how this breaks out on the scorecard itself. Again, it is extremely similar to the active fund scorecard. We still have 80% quantitative, 20% qualitative factors. Those breakdowns and weightings for each of those quant factors are the same: 30% style, 30% risk return, and 20% peer group. I'll just highlight, as I highlighted in the previous slide, that the style factors are slightly different because we're looking at different funds here. We want to measure the risk level. So see if the fund either stays in its current risk level or drops out, and it'll lose points based off of that. And again, we want to make sure that the manager has diversified their portfolio enough. So we measure that style diversity instead of style drift here for asset allocation funds. The rest looks very similar. I won't go into it in much more detail, but this is the asset allocation scorecard breakdown itself. Now, one other area that is slightly different than other asset allocation funds is the target date scorecard. So with target date funds, some of you may already be familiar with this, but we use blended scores here. So we want to measure for target date funds both how each vintage in the target date fund scores, that asset allocation score, but also how well the fund manager is doing at selecting their underlying investments. So we have created a blended score for target date funds, which takes into effect both that asset allocation score and selection score and weighs them evenly. Now, it might sound confusing on this slide, which is why I've broken out what it actually looks like on the scorecard. So I've used BlackRock here as an example. So that allocation score, BlackRock has 10 vintages, those 2025, 2035 vintages. And so we score each of those and then average that score, which comes out to 7.7 in this case. And then we blend that or average it, give it a complete 50-50 average with the selection score. So BlackRock has 6 underlying investments. You can see them there with that second green arrow. And those average to a score of 9.7. So then we take that 7.7 allocation score and that 9.7 selection score, and we get that target date fund blended score, which is that 9 on the right hand with the red arrow pointing at it. So I thought it would be important to note and point out that in the asset allocation section of the scorecard, this is a different category, and we use the blended score here. All right, so I see a couple questions popping up. Yes, so going back to that previous slide, I have a question. Is the target date fund scorecard averages always 50-50? Here, the blended aspect, yes, we carry 50% weight on the allocation score. Those vintages, like I mentioned, how they score using that criteria I went over a couple slides ago, and then the selection score. So 50-50 weighting between those two. All right, so then I went over active and asset allocation funds. Let's go into the last category, which is this passive funds category. Now, passive funds are slightly different than those active and asset allocation funds. And that's because we don't need to look at as much of a longer period as we do with active and asset allocation. We swap out that 5 years of history with 3 years. And this is because we're no longer looking for outperformance, and it gives us a score a lot quicker than it does with active and asset allocation. So with that shorter time period, what does an ideal passive manager provide? Here, we want passive funds to track the benchmark, stay true, very true to their style purity. So with that benchmark tracking, we want to make sure, and we measure this higher with passive funds, that they're staying consistent to their style purity. I mentioned the example with large cap value before. Here, it's the same concept. We're just measuring it a little bit higher, and that they're staying very consistent to their stated objective. And then secondly, tight benchmark tracking. That's the goal of a passive fund. We're not looking for outperformance anymore. So we just want to make sure that they're tracking their benchmark very closely and tightly. And then finally, since there is no need to outperform, we don't need an active manager. We don't need to pay for that additional service. So we look for low cost and passive funds. So we compare those expense ratios, both in the peer group rankings, as well as qualitative factors on the scorecard, which I'll get into in the next slide. Again, no longer looking for outperformance. So we remove those risk return factors and replace them with the bullets that I just outlined above. Same thing here, we use industry standard benchmarks specific to each asset class. So Russell, MSCI, Bloomberg, Barclays, among many others, just to name a few. And then we still use custom RPG peer groups that omit those active funds. I'll use an example here just to really highlight how this is creating a better apples to apples comparison. Let's use fund expense ratio as an example. Passive funds offer very low expense ratios as compared to active funds. If we lumped all of those together, both active and passive, we wouldn't be able to see how well these passive funds compared in their low cost offerings with those active funds grouped together. So by separating those two out, we're able to have a way better apples to apples comparison and see where peers rank among similar peers. So something unique, just again, a diversifier against other scoring systems that we do that for RPAG. And then I'm sure you're all familiar with this slide now. Here, though, it might look a little bit different on that left-hand column. As I mentioned, we're no longer looking for outperformance. So here we still have that 80% quantitative factors, but we remove risk return factors and replace that with additional style and tracking factors and additional peer group rankings, because we want to make sure that the fund is staying very style pure and tracking its benchmark. And then we want to make sure that they're ranking against peers. That's the whole purpose of the passive fund, is to just track its benchmark. So it's good to add additional peer group rankings there. Qualitative factors are still 20%, as you can see below. All right. So I went over what the scorecard is and what it tells us, how RPAG scores funds in the system, and how the scorecard is used, how we break out each of those fund categories: active, asset allocation, and passive. So let's go over why use the scorecard and what are those advantages that it has. So the scorecard has a ton of different advantages, and you'll notice that most of these bullet points are items that I've gone through throughout this entire presentation. So the first one, huge advantage, is that it aims to find good managers. We're not just looking at returns. We're not just looking at expense ratios. We're looking at a bunch of different quantitative and qualitative factors that allow us to judge how well a manager is doing. Secondly, it focuses on long-term performance. We're not just looking at that short-term quarter or year. For active and asset allocation, where we're looking for that outperformance, we use 5 years of history. So huge advantage there in our quantitative research. And then it integrates into the IPS using that scoring methodology, that 0 to 10, watch listing, maintaining, adding funds, and eliminating funds. And then it also provides custom benchmarks in that asset allocation section. So we use the custom style benchmarks. That's a huge advantage because we're able to see how asset allocation funds really do against a benchmark. And then finally, we use returns-based style analysis. So in those style factors and in the custom style benchmarks, we're using returns-based style analysis, which is a really big advantage because we're able to look at how the fund has acted over a longer time period. We're not looking at short snippets from quarter to quarter. We're able to look at how the fund has really acted over a longer time period. And so I'll also highlight on this slide, there's a bunch of different resources out there in RPAG. I mentioned the asset class review throughout my presentation. That's a great tool in diving deeper into the scorecard, seeing where the fund has met those pass-fail criteria, and it gives some great visuals that can be found in Fund Lookup, and you can compare multiple funds in one report. Additionally, the Resource Center has some great presentations that go into the scorecard methodology and outline some of the things that I went over today. So don't forget that those are great resources out there. The asset class review is one that I know our investment team uses probably on a daily basis. So it's a really great tool out there. I'd like to thank you all for joining us this week. I'll announce that our next camp counselor will be Luke Vandermillen Jr. We'll be going over benchmarking spooky stories around the campfire. So stay tuned for that one next Wednesday. It sounds like it'll be an exciting one for sure.
Awesome. Thank you so much, Karina. And thank you everybody for joining us. We hope to see you next week during our next camp session. Have a great day. Take care.